So my returns are a full 100% higher than the S&P 500. Here's where it gets interesting though. I'm not even counting the dividends in my returns. When I look at the dividends, every year now from this particular stock, my yield on cost is 16.5%. Hey everyone, this is Ian from ppcian.com. Today's video is a really exciting one. I want to share with all of you out there how I am personally crushing the S&P 500 index. Today's video is a response to a lot of the comments that I've received here on my YouTube channel. There's been a lot of comments saying, hey Ian, you're telling me I can do 7% per year results growth with your dividend growth stocks, but can I just do better with the S&P 500 index? S&P 500 index historically has done 10% per year, and there's been just a lot of interest in learning more about the S&P 500, S&P 500 index funds in general, and I've shared my philosophy in the past about why I don't invest in index funds. So I'm not going to repeat that there. I'm going to link below in the description to some of those videos that explain why I personally stay away from index funds for my strategy, which involves early financial freedom. I want to generate, and I am generating, a massive amount of cash flow that's coming in that will one day surpass my living expenses. And so investing in a vehicle like the S&P 500 index fund, it just does not align with my objectives of living off of dividend checks. But more than that, investing in the S&P 500, it would provide me with inferior returns. I'm seeing better returns, better results by investing in dividend growth stocks. And so I'm going to share some examples today from my portfolio. I picked a few stocks from my portfolio. I want to discuss how the returns have compared to the S&P 500. Before I do that, however, I just want to share something that is really important for everyone out there subscribing my channel, watching my channel to hear. I am a very conservative modeler. When I model my portfolio, I buy a stock, I'm making kind of forward projections on what that stock can do for me. I model conservatively. This is just how I have been brought up. Through my decades of experience in the stock market, decades of experience as an investor, I have always learned that I need to model conservatively. Why? I don't want to set myself up for failure. I don't want to set false expectations with myself where I'm counting on something and it doesn't pan out. I want to invest at a conservative, I want to model at a conservative manner where I can trust those numbers. This is very different, very, very different than what most of, or maybe not most, but many of the talking heads out there, whether it be online, whether it be on the TV, may convey to the general public. There's a lot of hype out there, a lot of interest right now, a lot of celebration with our stock market at all-time highs. You can turn on any YouTube channel or news station and everyone is cheering it on. And that's good. Everyone should be excited with the good returns. But that being said, I never want to get too confident. I never want to think that this is going to go on forever. And so fundamentally, when I speak about dividend growth investing on my channel, and when I'm speaking not only to all of you out there, but to myself as well, because this channel is a reflection of my personal strategy, I always model at 7%. That's just what I do. Even though the S&P 500, since its inception back in, I think, 1928, has returned 10% annualized, I model at 7%. Why do I do that? I want to factor in inflation. Inflation eats away at those returns because the cost of buying things tends to go up over time. And so modeling at 7% is more of an inflation-adjusted metric. It's more of a conservative metric. Yes, I could model at 10%. I don't do it. I want to play it safe. And so before I get into anything today, before I get into the specific examples, I just want everyone to be clear that in my opinion, the dividend growth investing strategy is the best strategy out there. And not only from a standpoint of financial freedom and generating massive cash flow, but also from the perspective of just beating the S&P 500, beating the benchmarks, beating the index. One can do that with dividend growth investing. And I am living proof of this. And so, again, I'm getting all these comments. Ian, should I just invest in the S&P 500? Most investors don't beat the S&P 500. This is another important nuance before I get into my examples. I really believe in life that what one believes becomes reality. And so if one is reading out there in the press, online, they're being told things, you're not going to beat the S&P 500. Only a small percentage of investors do. It's really hard to beat the S&P 500. Look, managed mutual fund managers can't even do it. If one reads this, hears it, believes in it, well, maybe that will be the case for someone that believes it. But in my case, I don't believe that. I believe that I can beat the S&P 500. I'm living proof of it. I have beaten the S&P 500. I beat it consistently. And I'll leave it at that. So all I'm saying is be very skeptical. Don't believe everything you hear. And in fact, it's important in life to choose who you listen to and who you don't, and to tune out certain sources of information. If certain sources of information are just telling you you're going to be average, you're going to live an average life. Why don't you just, or you're going to be below average. You're going to live a below average life if you invest in anything other than the S&P 500. And the best you could ever hope to do is to be average by investing in these index funds. That's not a reality I want to have. That's not a reality I want to live through. That's not a reality that's going to get me to financial freedom at an early age so that I can live life completely on my terms. I can have an abundance of cash flow that pays for everything. If that were my reality and I subscribed to that kind of information coming my way, I would not be where I am today. I wouldn't be half of where I am today. And so that's the challenge that the higher level message that I put forth from this video. Everyone's going to take their own approach, and I don't want to completely discount index funds. I think there's a lot of great uses for index funds, especially in retirement vehicles where individual stocks are not available. I typically prefer an index fund versus a managed mutual fund. And I think in certain use cases, everyone's financial picture is different. And so I can't possibly speak to everyone's situation here. So I don't want to discount index funds completely. I think they actually are a really good invention. I think there's many good use cases for them. I'm just saying in my personal situation where I am striving for excellence, I'm striving for greatness, and I'm striving for something a little different, a little out there, which is this early financial freedom that is so hard or can be so hard to obtain, especially in an area like where I live in the greater San Francisco Bay Area. It's very expensive. And so in my case, at least, I've had to challenge these norms, and I don't believe everything coming my way, and I do believe in myself and my ability to beat the S&P 500. So here's what I'm going to do. I'm going to pull out my notebook. I've got a few examples in here. All right. I just wrote down a few. Here's the deal. My portfolio is a dividend growth portfolio. I have averaged into a variety of positions over the years. Making a overall portfolio comparison to the S&P 500 at this point will be kind of difficult from a record-keeping standpoint. It's something that I'm working towards. I have a lot of work to do in Excel before I get there, and that's okay. It gives me something to do when I've got precious free time, but it is something I enjoy, financial modeling. But what I did is I picked a few stocks at random. And I'm serious, I picked these at random, and you'll see some examples here where I've matched the S&P 500 more or less, and some where I've really beaten the S&P 500. So let's take example one. I bought stock number one in 2009, early 2009. On that stock, without counting reinvested dividends, the way I'm accounting for it, I'm not looking at the reinvested dividends or the dividends at all in my results. I'm purely looking at the capital appreciation. On this particular stock, I have earned a 308% return. So for every dollar I've invested, I've made $3.08 in addition to the $1 that I originally invested. Now, what's interesting is the dividend. Well, first, let's talk about the S&P 500. During the same time period, the S&P 500 is up 197%. So my returns are a full 100% higher than the S&P 500. Here's where it gets interesting though. I'm not even counting the dividends in my returns. When I look at the dividends, every year now from this particular stock, my yield on cost is 16.5%. Meaning, for every $100 that I invested back in early 2009, I'm receiving $16.5 per year in dividend income. 16.5%. This in the dividend alone now that I'm receiving each year is higher than that 10% historical return of the S&P 500. This is the power of dividend growth investing. Not only is my capital appreciation completely dwarfed the capital appreciation of S&P 500, but my dividend yield alone now is snowballed so far that the dividend yield is returning to me in cash a greater return each year than the S&P 500 has historically returned. That is amazing. So that's a really good one. The first stock I picked was a really good one. Let's look at a more normal one. Okay, I bought this stock in October of 2013. This particular stock, I am up 56%. During the same time period, the S&P 500 is up 49%. So I've outpaced the S&P just a little bit, but I call that basically in line. I've performed the same with the S&P. But again, my returns, just look at that capital appreciation. I'm not counting reinvested dividends or dividends at all. The dividends from that stock, I'm now yielding 3.6% yield on cost. So every year, 3.6% on my yield on cost in perpetuity, and it will only go up over time as that stock raises its dividend. And so, question out there is, hey Ian, should I just invest in the S&P 500? Well, first and foremost, I can't speak to that, but what I can speak to is my personal experience, and what I'm saying here is even in one of these not so good situations, or not so good, being up 56%, I've matched the performance of the S&P 500. I've slightly exceeded it. When you count the dividend, I've quite exceeded it. And the fact of the matter is, you hear out there, you're not going to do as well as the S&P 500. Well, here I have. In the first stock, I've dwarfed the S&P 500. In the second stock, I'm doing all right. I'm still beating the S&P 500. Third stock. This one I bought in mid-2013, and I am up 69% capital appreciation. During the same time frame, S&P 500 is up 56%. I've beaten the S&P 500 here, not so handsomely as the first example, but pretty handsomely here. I mean, this is over 10 basis points, 10 percentage points higher. And again, not including the dividend. This is just the capital appreciation, doesn't include reinvested dividends, compounding of dividends. When I look at the yield on cost for this third example, I'm yielding 4%, 3.99%, basically 4% yield on cost. Pretty cool. Every year, for every $100 I invest, I'm making $4 return. And that only goes up over time. It goes up each year because the companies I buy raise their dividend each year. So let's look at another example. This one was an interesting one. I purchased this stock in early 2011. This one, I'm up 129%. Again, not reinvesting the dividends. S&P 500 during the same time is up 97%. Okay, I am up over 30% more than the S&P 500. Again, didn't reinvest the dividends, or at least not counting the reinvestment of dividends in my modeling. I'm yielding 5.5% yield on cost there. That's amazing. 5.5% yield on cost. So these four examples, in my opinion, really drive home the point today. In 3 of the 4 examples, I've crushed the S&P 500. In the first one, really crushed it. In one of the examples, I'm pretty much on parity, although slightly ahead of the S&P 500. And again, I picked these more or less at random. The first one I cherry picked because I wanted to show an example of one of my winners, but the other 3 more or less random. These are representative samples of my portfolio. And don't get me wrong, I have had a loser here and there, but more or less, these are representative of what I have experienced as a dividend growth investor. And so on the capital appreciation side, I've at least kept pace with the S&P 500, if not outperformed it. And then on the dividend side, you add that into the mix, I've really crushed it. And so S&P 500, if I just invested in that vehicle, I would probably, to achieve financial freedom, or if I wanted to start living financial freedom at a younger age, I'd have to dig into my principal. I'd have to start selling shares to finance my lifestyle. But with dividend growth investing, it's getting me to the financial freedom mark quicker because the returns are better for me that I've experienced. And my cash flow is superior. I'm getting more cash flow, much more than I would achieve by investing in the S&P. And what that means is I can live completely off the dividends. I don't have to touch the principal, which is my ultimate goal, because I never like selling stock unless it's one of these rare corner cases. And so, again, this is a bit of a rant today. I know I've been going on a while, but I really want to discuss this point because I get all of these questions, and every time I get it, honestly, I cringe a little bit because I can see the conviction that the people asking this question have. And I can see that they've bought in to the marketing out there. And I'm not saying it's wrong because, like I said, everyone's case is a little different. But I'm trying to provide a counter argument here. I'm trying to provide a very different perspective. And I'm hoping that this perspective at least gets people out there thinking. If you've heard my perspective and it doesn't make sense, or if the S&P is still the right way to go, more power to you. I mean, there are many different strategies that work for many different scenarios. But at least what I'm trying to do is provide a different strategy for people trying to live off of dividends, for people trying to achieve an early financial freedom, where the results, not only in my experience, have beaten the S&P 500, but the cash flow is just so much more substantial than what would be possible otherwise. This is why, after my decades in the stock market, I have really latched onto this strategy, and this is my main strategy now. I dabble in a few other things to try to accelerate my returns and get more capital to invest in dividend stocks, but my main strategy at this point is dividend growth investing. My name is Ian Lopuck. I am from ppcian.com. If you enjoyed the video today, I please ask you to subscribe, to like the video, to comment. Your comments mean the world to me. And just a note on that. If you disagree with me, that is okay. Please put it in the comments. My channel is not meant to be a monologue. I know there's not a one-size-fits-all strategy. If you have a different way of doing it, and it's better than my way of doing it, I have no pride behind my strategy here. I mean, I do, but at the same time, I respect other ways of investing. And so I also just want to add that here, that I'm not trying to put down folks out there who have subscribed to other strategies. In fact, I respect you, and I respect everyone in our investment community here on YouTube. Before I leave, a friendly disclaimer: I am not a licensed financial advisor. Today's video is not financial advice. My video is just for your fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a financial advisor first, a licensed one. Thank you so much for watching. I will see you in the next PPC Ian Dividend Investing video.